there's 7 key fast grower characteristics this year. Um, but before I highlight a few of them, I think something that this study also illustrates, which I think is really important, is how growth stage companies are really focused, they're multi-threaded. They're focused on several value drivers at one time.
Welcome to the Tearsheet podcast. I'm Zack Miller. For venture investors, it's really hard picking winners consistently over time. Kelly Ford, a partner at Edison Partners, has been studying the attributes of successful startups in her work on Edison's Growth Index. For more than 30 years, the venture firm has been helping CEOs and their teams grow and scale successful companies. The Growth Index, which studies the firm's portfolio of growth stage technology companies, finds that fast growers, or companies with 30% or more annual growth, share 7 key characteristics associated with their growth. Edison's Kelly Ford joins us to talk about the key takeaways from this year's Growth Index, which saw a couple of new things added to the report. She discusses how Edison uses the research as part of a broader initiative called Edison Edge, which is a program designed to help portfolio companies scale smartly and efficiently. We also chat about Edison's portfolio and where it's looking to make further fintech investments. Kelly Ford is my guest today on the Tearsheet podcast.
I'm Kelly Ford. I'm a partner at Edison Partners. We're a growth equity firm based in Princeton, New Jersey. I have a unique role, I think the best role at the firm, where I'm a recovering operator. So there's an element of my job where I'm an operating partner working kind of side by side with the executives in our companies, and I'm also an investment partner leading investments and managing investments in our enterprise solutions sector.
So I definitely want to get into some of the work you've done on identifying, high flyers. But before we do that, given your background, how does being somebody who has a lot of experience as an operator, how does that impact the way you look at making investments?
Sure. Our team is a mix of both seasoned investors as well as operators, and we team on every investment and really value the combination of the investor hat as well as the operator hat, from selling, evaluating, the way we support our CEOs and executive teams throughout the life cycle of the investment. And sales and marketing is a primary use of proceeds when we invest in a company. So back 5+ years ago, our managing partner, Chris Sugden, really had a vision to add operating chops to the team and start to build out, centers of excellence to help first, kind of accelerate go-to-market initiatives for our companies. And I was the first operating hire in that regard. We've since added other operating expertise and centers of excellence in the areas of finance and product management and in operations. We think the CEOs and the executive teams appreciate that there are folks here that have walked in their shoes. And in terms of, how we operate and think about companies and evaluate companies internally, I think our team benefits from having both points of view. It's a more well-rounded perspective on different companies' challenges and how to address them. And sometimes the operators around our table can really see things and help our team see things that otherwise might not be seen when looking through a pure investor lens. Folks who haven't really been walked in the shoes of these entrepreneurs and these executives. So for us, it's a really holistic approach and an integrated approach between, investment themes and thesis with, we look at market, product, and execution risk, and the execution and some of the product risk, relies heavily on this kind of expertise. So, and the way we make decisions, the way we work together with our companies, and I think ultimately the way, our companies can accelerate the value creation in their businesses is through tapping this kind of expertise at our firm.
Interesting. And one of the things I wanted to hone in on during this conversation is some of the work you've done around identifying, publishing this growth index that you guys have done. Can you first start by explaining what the growth index is and how you compile that?
Sure. So this is our fifth year. It, it, this report, it actually started as more of a sales and marketing and kind of pure sales and marketing unit economics study, and has evolved to be sort of all encompassing of top and bottom line characteristics of fast growing companies and how they differ from their slower grower peers. Each year we survey our portfolio of tech companies, and those companies range, just shy of 10 million in revenue to really over 50 million in revenue. And we examine, both top line and bottom line metrics, different dynamics, in order to determine what sets fast growers apart. And our definition of fast grower is companies growing top line 30% year over year. Each year there are some core, kind of consistent threads that we see each year around use of, the way they spend. These are mostly SaaS recurring revenue companies, though there are some exceptions to that. So you do see patterns and consistency year over year, but each year we also try to draw out qualitative in addition to the quantitative in terms of things that these companies are doing that are really setting them apart and continuing to propel them as fast growers.
So I'm sure our audience wants to hear what some of those things are. Can we start by digging in there?
Yeah, sure. So there's 7 key fast grower characteristics this year. But before I highlight a few of them, I think something that this study also illustrates, which I think is really important, is how growth stage companies are really focused. They're multi-threaded. They're focused on several value drivers at one time. And it's really, we're growth equity investors. And when we think about this growth stage company, it's more than the kind of top line laser focus of most VC backed startups, where it's top line growth and too oftentimes can be growth at any and all costs. These growth companies are really multi-threaded. They're focused on several value drivers. And I think this study really showcases what those levers are and those drivers are. Namely, like these characteristics, it'll be no surprise that, I guess the old adage applies of, you got to spend money to make money. So, no surprise that fast growers have 100% higher investment as a percentage of revenue in sales and marketing than slower growers. Mm-hmm. That's a consistent thread every year. The primary use of investment and majority of expense really is spent in sales and marketing for these companies. And in a new development this year, we looked more closely at not only what it takes to acquire, but also what it takes to ensure the success post-sale with these companies, customers using their products. So we've also found that this, spending more on sales and marketing, likewise, these fast growers spend 6x more in customer success, ensuring these companies are, their customer companies are trained on the product, adopting the product, and in making good use of it. So expense, sales, marketing, customer success, certainly more than companies growing less than 30% year over year. We found that fast growers are also more successful at capturing maximum value from their customers. So, they land them and they expand them. And whether that's, organic growth within the customer base or selling them more in different product. So it can be consumption based. It can be that these companies are becoming more mature and they have more to sell their customers, but overall, these fast growers have 75% higher contract values than their slower grower peers. And, sort of qualitatively, what we found as a driver of that are more sophisticated value-based approaches to pricing. And some of that might mean, they have a more mature product portfolio, because many times at the time we invest in these companies, they might be a one product company. But either driving more value, driving more consumption of their product, or having more to sell, and really being thoughtful about how they price and capture value. That was a big takeaway this year. And for companies both at the low end of the revenue range and not surprising up through companies with more scale.
Now, do you see these as inputs or the product of becoming a fast grower? I guess that's one of the questions you must get asked a lot. Like a lot of these, as you described yourself, like these are the products of having started as a one product company and have emerged into sort of multi-threads or whatever. But how do you use this? How do you use this data? I guess if you're an entrepreneur, I'm looking at what makes up a fast grower. Like what do I do with that information?
Yeah, it can be indicative. We certainly use our companies use this data and to sort of compare themselves. Oh, okay, this company at my revenue size or the revenue size I'm trying to get to in this sector with a business model like mine or a go-to-market model like mine, is capturing deal sizes of X, and we're only at Y. How do we do that, right? And likewise, we use this data to, when we're evaluating companies, to say, okay, well, this company's at 15 million in revenue. They're growing 40% year over year. The unit economics look great over here, but not over here. How much risk really does that represent, or how can we help them get them to where they need to be? Can we get comfortable with that? And when we have points of comparison where we have been able to help companies move the needle, or they've done it on their own, these are just great comparison points. And then to also have them year over year, knowing there are some market dynamics that can contribute, but a lot of this is really just operations and execution. So we use it in evaluating companies and making sure we're on top of, the right expectations of these businesses. And then, they're useful benchmarks for our companies to say, okay, what are we missing here? Or is that a missed opportunity? And there's, the sales and marketing and customer success, the pricing, these are always hot topics. We engage, I probably talk to someone every day in our portfolio about these topics, but there's also, finance and HR related dynamics that, where this study is useful in some of these findings. Revenue per employee, fast growers are 3x higher revenue per employee than slower growers. Well, that's a big general number, but and it's related to certainly some of those other dynamics around it. What are your contract values and how are you driving them up? But there's, it's a metric that, our CFOs and our CEOs may be thinking about, but the heads of sales and heads of marketing aren't necessarily thinking about, right? So you've got to kind of marry these metrics together. And something that, I think we're comfortable with in this growth stage, particularly, for these fast growing companies, is loss rates, right? Like these
I have to imagine if they're spending very heavy on the front end that they're going to be losses, right?
Right. And, within reason, but fast growers have significantly higher loss rates than the slower grower peers. Now, slower growers really should be operating at, be profitable, or at least at break even, growing less than 30% year over year in our view. And particularly the companies at subscale, are going to have higher losses. But to some extent, we saw companies even, sort of above 10 million, under 25 million in revenue that are still incurring significant losses. But the growth is very strong, and the unit economics otherwise are very strong. So, there's trade-offs there. But it's that's been a consistent theme year over year as well.
And so how does this type of research tie into some of the other work you do at Edison to help nurture companies? And you talked about a little bit about it, in the course of this call, but I know you have something called Edison Edge. Is this part of sort of the services that a portfolio company would get from you guys to help them move to the next stage?
Yeah, so Edison Edge is our operating platform, which, this study is part of. It's, access to this platform is what comes with our check. It's of no cost to our companies. A lot of firms talk about value add and, how they support and, provide a support system or a set of services, portfolio services to their companies. Many of them, there's fees associated with that, certainly at the PE level, and some at the growth equity level, and it tends to be just a smaller investment, usually at the VC level. So we've made a significant investment. We don't charge our companies. This platform is run by, a team of former operators. As I mentioned earlier, it includes access to best practices and executive education programs all around growth acceleration, scale, and leadership. I'd probably boil it down into those three, and then spanning, sales and marketing, product, finance, and operations and human capital. So we have centers of excellence and team of folks who have seen the movies for this stage of business. Also, as part of the operating platform is we have a board director development program, which we believe to be pretty unique to the industry.
So what is that?
And perhaps the largest in the country. So our Edison Director Network is a group of 300 or so experienced, current and former CEOs and board directors who have served on boards with us and our companies over the years. And we, continue to curate this community. We engage with them, or we facilitate the engagement with them and our companies, and match based on, expertise, based on stage, based on market, geography. And, when outside the boardroom, continuing to develop board directors and board leadership skills for these board directors is really important to us, just as, we invest to support the executives working inside our companies. We think it's paramount to have seasoned operators around the boardroom table and folks who really understand what it means to use the board as a strategic weapon, kind of the stuff beyond governance. And we invest heavily in, we used to call it, we had been calling it over the years, director college. Mm-hmm. So we bring these folks together and we design sort of curriculum, and we have a lot of, playbooks and guidebooks, and we use them to help us make this curriculum better for folks in this community, and ultimately for the CEOs and in the companies that they're helping to support through serving on their boards.
So in the remaining time that we have, Kelly, I'd love to tie this back to fintech. Given some of the, sort of the attributes that you look for in high performing companies, can you talk about, I guess, Edison's thesis around fintech? What sort of subsectors you looked at? What are some of the themes in the sector, and sort of talk about the portfolio that way?
Sure, yeah. So generally, across our sectors, we look for high growth companies that are, 5 to 20 million in revenue. They've proven product market fit. A lot of times the product feels more mature than the company. So, and they've been reasonably capital efficient, meaning they haven't raised a lot of money prior to our money going in. Strong unit economics, as I mentioned earlier. So that's sort of the general profile of the type of companies we would invest in. Heavily recurring revenue models. We look at healthcare, enterprise solutions, and fintech. And for fintech sector specifically, I'd say we avoid the areas that are overhyped, and tend to focus on, I'd say there's probably 4 key areas that we continue to be excited about in fintech, and it's representative in our current portfolio as well as investments we continue to look at. One is this theme around democratization of financial services, and we've seen this in banking, lending. We're now seeing extended forms of real estate technology. So that's been a theme for several years, and one we continue to lean in on. Reg tech and compliance. Some might think boring.
Yeah, exactly. That's the first thought that went by my. Yeah.
But there's some pretty interesting developments and innovation that continues to happen in those spaces, particularly around data and AI, and there's really a interconnection there in terms of enterprise software and things we like about business applications, particularly vertical business applications that serve large enterprises. Reg tech and compliance kind of intersects there. We were early investors in payments space, and
I was going to ask that if you see new opportunities coming, given the fact that you've been successful in that space.
Yeah, I think there are areas that have just been done, but there's still really interesting plays around prepaid and virtual cards and applications of these payment technologies and solutions for different segments and in sectors of the market. We're pretty excited about different SMB applications and how payments and payment solutions for small businesses are really sort of changing the treasury and banking landscape. And I think there's more to come there. And likewise, payments is kind of an ingredient. It's becoming part of, part of everything now in terms of, from instant paydays and, or getting paid, employees having the flexibility and control over getting paid in advance. And there's lots of sort of interesting intersections, applications on the B2C and B2B2C as well as B2B side.
Well, Kelly, thanks for joining us and sharing all that information on the Tearsheet podcast. I appreciate it.
Thank you for having me.